Well, hello there, and greetings once again, and welcome to Wealth According to What You Know. Thank you so much for taking a moment to be with us. And as we want to grow this channel, as we want to share the information and knowledge in which we've been given, our goal is to help hundreds of thousands of people break away from the burden, the stress of debt, and just tight money situations. But in order to do that, we got to educate ourselves. And to me, that's one of the primary opportunities that we have in bettering our lives financially is getting the information. It's always been said, what you don't know don't hurt you. My add on that is what you don't know does hurt you. You just don't know it. And so, what we want to do is to help educate you here on Wealth According to What You Know. My name is Raw Walter. I'm the host here. And again, thank you. And hopefully, you will learn something from this. As today, we have a very interesting topic that we'll be discussing and talking about today. And that is to refi or not to refi. That is the question. Now, in earlier video, we had the same conversation, but we were talking about to determine whether or not refinancing a home mortgage, whether or not it was a good thing to do based on determining the break-even analysis. And so today we're going to explore beyond just the break-even analysis, and we're going to talk about what I call the net analysis. And we're going to break that down so you really understand what we're talking about. It's important that you get both pieces of this equation to make that decision. Before we go on a little further, please do us that favor, subscribe, like, comment, and share. We're really trying to grow this channel, and it helps when you do that. Subscribing to it costs you nothing. Pressing the like button costs you nothing. Making a comment costs you nothing. And to share the video costs you nothing. So please help us do that. And we want to give our disclaimer. We're not financial advisors nor experts. We do not claim ourselves to be giving warranted information, but we do believe the information which we're sharing has been verified by ourselves, and we pray that you do the same thing as well. Do your own due diligence, determine what decisions are best for you and your family. And so as we explore this topic of refinancing, again, just want to just give a quick little review. What is refinancing? That is when you take an existing mortgage and you replace it with a new mortgage. In most cases, you're going to get a better interest rate. You're looking to lower your interest payment or your monthly mortgage payment, and in some cases, to even to reduce the term or the length of the mortgage itself. So we're going to be exploring under those conditions what would be the best decision that could possibly be made in most situations. We're going to look at four scenarios. It's going to be very helpful to you to help you understand how to determine this break-even analysis in terms of what I call the net analysis. And so again, continuing this review, why do people refinance? Better interest rate, lower monthly payment, opportunity to switch from an adjustable rate mortgage to a fixed rate mortgage to shorten the term of the loan, as I mentioned earlier. And then some people refi because they want to cash out some cash out of the equity in the home. So if they got 200,000 in equity, they may refi 200,000, 180,000, and take 20,000 out and do other things with it. And then also, it's a possibility that you may eliminate your PMI, private mortgage insurance. If you have at least 20% equity in your home, you can possibly eliminate the PMI portion of your payment, which would save you a couple $100 a month. So certainly keep on that equity in your home. Before I go any further, I want to take a pause and give credit where credit is due. The calculations that I'll be showing on the upcoming slides, uh, I've, the numbers derived from this came from a resource, an online resource known as calculator.net. I'm not an affiliate of theirs. There's no relationship, nor is there an implied relationship between myself and calculator.net. But I believe that this is a great website that you can go to because it has all types of financial resources and calculators on there, and the key thing is it's free of charge. But you can calculate mortgages, auto loans, amortization schedules. You can even get a projection on what your current or next year's income would be based upon numbers that it prompts you to enter. And I'm just going to click on that. You can see you can determine if what your marriage status is, and it's just basically plug and play, and it gives you a good idea of what your projected income tax would be. You can see what the impact of inflation is on a certain amount of dollars. What would $100 be worth at a certain given date? And it'll give you that amount. And then mostly what I'm working with today that you'll see in this scenario that we're talking about refinancing is using their mortgage calculator. And that's what's on the screen as well. And then to help us in our break-even analysis, I'll be using their investment calculator as well. So I would highly encourage you to bookmark this one here, calculator.net. Now let's get back to our topic on refinancing. Okay, so let's look a little closer at this here. So refining, is it a good option? And as we discussed in the previous video, please make sure you see the end screen to this or look in the description and get that earlier video where we did the break-even analysis regarding a mortgage refi. And that is where you basically take your total cost involved with the refi and you divide that by any monthly savings in your monthly payment, and that would give you the number of years it would take you to recoup or recover or break even for your refinancing cost. And so that is what we want to make sure that that we employ here. But that's step one, and that's really the beginning step. To me, the overarching formula in all of this and understanding whether or not a refi is truly beneficial is to do the net analysis. And that net analysis, it looks at the detailed long-term impact and effect on having a mortgage refi, not just how long does it take for me to recoup my refinance cost, but what is the impact of refinancing on a longer or for the duration of the loan. And so we're going to spend our time today in this video talking about the net analysis. All right, what is the net analysis? It's basically a long-term analysis of a mortgage refinance that goes beyond just determining the break-even point in order to recoup your refinancing cost. It involves several factors determining and help you determine what is the net detailed analysis over a long period of time. What is the long period gain or loss of a mortgage refi? And it takes into account the total interest paid, the monthly savings of the monthly premium, mortgage payment. If you did a refi and your mortgage payment dropped $150, what would be the result if you were to invest that over the duration of the loan? Any savings in terms of if you refied and you paid your home off earlier, what is that impact if you continue to save the difference? And then if I did not refi and didn't pay the closing costs, what would it be if I were to invest those supposed closing costs, but kept the same loan, but whatever the cost of a refi would have been, invest those closing costs? And so we're going to look at those items to help us to determine whether or not a refinancing would be the best, a good option for you. And so as we explore this here, we want to look at 4 different scenarios to gain an understanding of to be able to answer this question. And scenario number 1 is simply keeping the existing loan in place. If you kept this existing loan in place, there's no refinance cost. What would happen if we reinvested or invested that supposed refinance cost? Scenario number 2, we want to look at refinancing with the same term, meaning the same length of loan, but at a different rate. So if you currently have a mortgage, you only owe 27 more years on it. We want to refinance at 27 years, but at a lower rate. We want to look at refinancing with a shorter term. So if you only owe 25 years on your existing mortgage, what would it look like if you drop down to a 15 or 17-year mortgage with a lower rate? What would those results be? And then finally, scenario number 4 is refinancing at a longer term. That's extending the term of the mortgage. That so if you only got 20 years left on the mortgage, what would it be if you refinance at 30 years at a lower rate? So understanding these 4 scenarios would gain and help you to be able to have the information you need to make the best decision, along with the break-even analysis talked about in the earlier video, and as to whether or not this is a good idea for you. So let's go ahead and look at these different scenarios here. So scenario 1, do nothing. So on a typical $300,000 mortgage at 7%, you would pay $356,000 in interest payments alone, in addition to the principal that you would pay back. So you're talking well over 700,000. But the interest portion is $356,000. There is no savings in terms of the monthly premium or monthly mortgage payment because you didn't refinance. So you're going to be paying the same amount. Because of the fact you did not refi, a typical refi on a 300,000 alone would cost about $6,500. So in this example, and all of the examples we're going to be using, you have 27 years left on your existing mortgage. If you choose not to refi, well, then you kept $6,500 in your pocket. If you invested that $6,500 at 8% return, maybe in an S&P 500 index fund or something of that nature, over the life of the remaining time of that loan, 27 years, that 6,500 would grow to $56,000. And so now the net effect would be 356,000 negative in principal paid out, but you're gaining back 56,000 that you invested from your closing costs that you did not refi with, and that earned you resources. So your net now is a total of $300,000 that you would have paid out over and beyond the principal. And so that's scenario number 1. Scenario number 2 is to refinance with the same term but at a lower rate. So your existing mortgage has 27 years left. You're going to refi with a 27-year mortgage, but you're going to get a lower rate. And so if your rate is presently 7% in all of these scenarios that we'll be presenting here today, and the refi also would be the same at 6%. So you're going to go from a 7% loan to a 6% loan. What does that effect look like? Well, On this here, same thing here, the total interest that you would pay on a 6% loan would be $296,000, which is about $60,000 less than what your existing loan was right over there to the left. Your monthly payment typically is also going to reduce because of a lower rate. In this case, the monthly payment is $185 less under the refi loan than your existing loan. And so if you stayed with a 27-year loan and you invested that monthly difference of $185 at 8%, again in an S&P 500 index fund over to a 27-year period, that savings in monthly payments would total about $212,000. Now, you did have a refinance cost that you had to pay, so you don't get that savings. And then finally, the last line, you're not paying the loan off sooner than 27 years. So you got to pay this whole duration of the 27 years, so there's no savings there. So in total, now you take the $296,500 in interest payments and you subtract from that your savings payments from investing the difference in your monthly premium of 212,500. Well, now you've only paid a total net out of $84,000. And so you can see between the two scenarios, doing nothing will cost you 300,000. Doing something with the refi at the same mortgage uh, length but a lower rate, would you only pay out about 84,000. Let's look at scenario number 3. In scenario number 3, you're now going to refi at a shorter term. So in this example, you're going to go from a 27-year mortgage down to a 17-year mortgage, 10 years less. And you're also going to get that same lower interest rate. You're going to go from a 7% to a 6% interest rate. So how does that look? In this example, 6% on a 17-year mortgage, you're only going to pay $208,800 in total interest on that loan. That's a great difference than the $356,500 of just doing nothing. So by refining to a 10-year shorter term period, is saving you closely to about $140,000 just in interest payments alone. Now, here's what we're going to do. Now, because of the fact that you went from a 27-year mortgage down to a 17-year mortgage, you're paying that mortgage off 10 years sooner. So what do? So at the end of 17 years, when that new mortgage, that refi mortgage has been paid off, continue to pay your monthly payment of $2,078 a month for the next 10 years, because you originally had a 27-year mortgage. So in the original mortgage, you still would have 10 years worth of payments to make. So you're going to continue to pay, or as if you were paying the mortgage of $2,078 for 10 years, but instead you're going to be investing that money now into your S&P 500 index fund at earning about 8% average return. And therefore that would have accumulated for 10 years of $382,700. We do the same math now because of the fact that you did have to refi, and there was refi costs involved, and because you went with a shorter term mortgage, the monthly payment itself is more. And in this example, it's $83 more. So to go from a 27-year mortgage down to a 17-year mortgage was about $83 per month. Well, you had to pay a higher monthly payment for 17 or 20 years in this example here, and that total would be $49,000. So you paid $49,000 more in monthly payment amount for until that refi mortgage has been extinguished at 17 to 20 years. In this case, that's actually a typo. I got 20 years there. It should be 17. So for 17 years, you were paying $83 a month more. Had you invested that at 8%, that would have been $49,200. So that's $49,200 that you did not get. So you lost that opportunity to invest. But what it did do was cause you to extinguish your mortgage 10 years sooner. And now because of that, you can now continue to invest what you were paying in monthly payments for the next 10 years. You are now paying and investing in your index fund. And so now the net analysis in this scenario is you take the $208,000 worth of interest paid in total on the loan, but your investment savings for 10 years worth of savings as accounted to $382,000. You take out the $49,000 in lost opportunity to refi, and you're still positive $124,700. So by refining to a 10-year shorter loan period actually makes you money in the long run. So you're basically paying for the interest out of your investment and then still pocket an additional $124,000. That is very key to understand. And then in the final scenario that we want to talk about here is the one in regards to refinancing for a longer term. So let's say if you had a 27-year mortgage, but then you're going to take it to a 30-year mortgage. Now that's going to reduce your monthly payment by $256 if you look at that second row there. $256. So your payment will drop $256 less. And if you were to invest that over those 27 years, you would have $294,000. And then so the lost opportunity cost as well, you have to, because you did refi, so that's going to cost you money as well. And then you take, so when you run those totals, you see what that amount is. So you're around about $113,000 or so. So in all of this here that we see here, if you are at a higher interest rate on your mortgage, in just about most cases and scenarios, you would come off better refinancing that mortgage, providing you can get and secure a lower interest rate. I'm not talking about going from a fixed rate to an ARM. You could certainly get a lower rate with that, but then you expose yourself to market gyrations and higher and increased interest rates. But I'm saying going from one fixed rate or from a higher ARM to a lower fixed rate mortgage. If you can get it at least 1% less, in most cases, you're going to come out better in a better situation financially. And the best of all of the scenarios, as you see here, is to refinance at a shorter term. So you may pay, your monthly payment may be a little higher, but you're going to extinguish that loan much sooner, and you take the difference of when you pay it off and you continue to invest that monthly payment that you would have been paying on the mortgage, you invest it in something, into an investment for the duration of what you would have had the loan for, and you come out far greater in that areas. But most of these, scenario 2, 3, and 4, would outweigh sitting and doing nothing and carrying a higher interest rate on your mortgage. So these are things that you can consider, and hopefully this has been a benefit to you to help you determine that, along with the break-even analysis. So if you're going to be in your home beyond the break even, what the break even analysis does. See, the break even analysis basically tells you as to whether or not it's a good idea if you're going to be in your home for that time. If your break even point is 40 months, but you're going to sell your home in 3 years, it doesn't make sense. But if your break even analysis is 40 months and you're going to be in your home, or you project yourself in your home, maybe you got younger children, you don't see yourself moving anytime within the next 5, 10, 15 years, then that refi may be of benefit at that moment. And then you move over into your net analysis and you do the same thing and you run those numbers based on your projection of how long you'll be in the home. If you're going to be in the home for the duration of the mortgage, again, this example here proves out that scenario number 3 would be the best of all the choices. So, warning, warning, warning. I had this in the last video. I got to place it here again. Do not refinance your home and do a cash out refi just in order to pay unsecured debts. That means don't take equity out of your home, whether it's a home equity loan, a refinance, a HELOC, whatever it may be, to go and pay off mortgage, to go pay off credit card debts. I know in some limited situations that may be a great thing to do, but when you do that, make sure that you are disciplined, you know exactly what you're doing, because otherwise you are transferring unsecured debt into secured debt. Meaning if you don't make your credit card payment, they cannot come and take anything out of your home from you. It's unsecured. That dress you bought, those new shoes you bought, that those Jordans you bought, whatever you purchased, they can't come back and retake from you. But then once you pay off those credit cards using equity from a refi, your home is now exposed, because they can come and take your home. Not the credit card company, but the mortgage company can take your home based on the credit card debt that you rolled into the home. So that's just a caution and warning I want to put out there for everyone. So in summary, let's look at this here. It's important to analyze both the break-even point as well as the net analysis, the total impact of the refi over the length and the duration of the mortgage. You must factor in the total interest paid, the invested saving opportunities, and lost investing opportunities in order to determine the net analysis. Often it is more advantageous to refi with a shorter term with a lower interest rates than any of the other scenarios in which we have shared here. And then warning, think long and hard before refinancing to pay off unsecured debt such as credit card, department store cards, gas cards, things of that nature. So we're going to end it here today. So please make sure you click on that next video link down in the description or in the end screen of this video. Please stay to the end. It'll be easier just to click that video from there. And I believe all of this is going to help make some great decisions for you or help you to make great decisions in this here. As always, let's have a word of prayer. Father, we thank you for everything that you've done and have taught us, Lord. And we ask you, Father, that those that are in this decision, seeking guidance from you, that, Lord, that you would guide and direct them into the perfect way of what your will is. In Jesus Christ's name we pray. Amen. Well, thank you so much for being with us, and do us that final favor again. Share, like, subscribe. Have a great day.